Welcome to the Academy. Interest rates, clearly a hot topic because they affect so many aspects of our lives and not just the world of trading and investments. Now, this week, I've had a few inquiries about an article that appeared on a UK news channel discussing mortgage rates, how they were rapidly changing and how some UK mortgage lenders were pulling their mortgage offers literally within weeks and sometimes a lot less, leaving people to come up with a quick decision on something that could heavily affect their lives. The question is why? Why are mortgage rates moving so rapidly? Because this article went on to talk about the path of future interest rates and then immediately started to talk about the central bank rates. Now, clearly, the two are connected, but maybe not as directly as the article would have one think. Because after all, the central bank here in the UK hasn't moved for a while, and yet these mortgage rates are seeing high volatility. The question is why? Now, the problem with just associating one directly with the other can lead to confusion. It can lead to much confusion. I mean, after all, we have the central bank rate, but we can't personally use that rate. That's a rate that's the basis for all other rates that we speak of, but of course, it's not one we could personally use. That rate can be used by the banks that have an account with the central bank, their reserve accounts, and they can use this as the basis or as a target, of course, for everything they do within their world. But that's not a rate that we can personally use. When you see a central bank rate, it's often not the same rate we could borrow money at or even deposit money at. But it is obviously the basis, the starting point of discussions on interest rates. The banks use that base rate and they use that rate within the interbank world where they're trading amongst each other, lending and borrowing from each other, and of course, creating a further reference for the products that they offer us. Deposit rates, loan rates, mortgage rates, credit card rates, and all of those things. And here is where the confusion escalates, because we talk of so many different interest rates. The term is simple, but it can also be rather ambiguous. We've talked about central bank rates, deposit rates, mortgage rates, loan rates, credit card rates, money market rates, bond rates or bond yields, swap rates, all of these things. And the list seems to go on and on and on. And for the uninitiated, it becomes very, very confusing. And that's before we add further rates to the existing rates when we think about credit risk and credit scores and credit ratings. So in this brief discussion, let's just start by talking about where do rates come from?
I want to start with a rather hypothetical example where our bank is offering us two different rates for two different periods of time. 6% per annum for a 1 year period of time, 8% per annum for a 2 year period of time. So 8% for those 2 years. Now, I'm also going to imagine, I know this is not reality, but I also want to imagine that we can both borrow and deposit at these rates, just for something that we'll talk about in a few moments' time. But I want to think about it from initially the borrower's perspective, imagining these were perhaps mortgage rates on offer, where we are given a mortgage offer and we've got to decide rather quickly whether perhaps we fix our mortgage at a certain rate for a 2 year period or fix our mortgage at a different rate for a 5 year period or so on. So I'm going to think about it from a borrowing perspective to begin with. We're looking to borrow 1 million and we have these two choices. If we go for the first choice, where we are going to be charged 6% per annum, that's 6% on our million principal here. So that means at the end of the year, we would owe 1,060,000. Or if we go for the second choice, where we're borrowing money at a rate of 8% per annum, at the end of the first year, we would owe 1,080,000, which is then compounded forward. So we're compounding our interest here forward for a second year at the same rate of 8%, meaning that we would owe 1,166,400. But we're trying to decipher where these rates have come from. That's the whole idea of this exercise. Where do rates come from? Where has the bank got these rates from? And what do these rates actually imply in terms of the bank's thoughts on future interest rates? Because we're dealing with two different time periods here. Now, it's always wise that we have our own opinion on where we think rates are going to go, And then we can see where the banks are implying these rates are going to go and whether we can do something that works for us. So in order to work out whether these rates are fair or to see what these rates imply, we need to know a further rate, and that's the rate for the period in between. So we're looking for this rate here on a period that we are going to, for simplicity's sake, throughout this example, refer to as the 1 times 2 rate. The 1 times 2 rate. The rate that begins in 1 year's time and ends in 2 years' time. So we're going to try and see if we can establish what that rate is. Now, we'll do the maths in a moment, but just initially, I want us to think about this in a simple, intuitive way. This long period rate, this 2-year rate, this 8% per annum for that 2-year period is effectively an average of the first period here at 6% and the period here that we're trying to work out the rate on. Now, with that in mind, with that simple average thought process in mind, and again, just as a side note here, this is not a simple average. We're using what we call time series data here. So we need a geometric average, but enough of that. We are going to go just think about it in a simple, intuitive way. If we're thinking about simple averages, then we know that this rate that we're going to try and calculate very shortly should be greater than 8% per annum. And why is that? Well, again, think simple averages. 6 plus 8 is 14. 14% divided by the 2-year period would be 7%, which is clearly too low given the numbers that we already have. Using that same logic, we would say that the rate therefore has to be approximately 10% per annum. It's got to be approximately 10% per annum. Then, of course, it works. 6% plus the 10% gives us 16% divided by the 2-year period. That would give us 8% per annum. And the numbers work. So the numbers we have here are implying that that rate, that 1 times 2 rate, that forward rate, the rate that begins 1 year into the future for 1 year, has to be approximately 10%. Now, this is all based on something called the no arbitrage principle, the no arbitrage theory, because we're looking at what these rates are implying, the rates that we can observe, what they imply, and whether this is correct. And you can work between one to the other. So we're looking to see whether something doesn't add up, something doesn't perfectly work out. And that could allow for this thing called arbitrage, where even the smallest difference between the rates could mean that we would have an opportunity to take advantage. If, for example, when we're looking at these numbers, we find that maybe this rate is too high, this 8% for the 2-year period is too high, then we'll think about the fact that, again, assuming we can do this, we could deposit money at that higher rate. If that rate is too high, we're not looking to borrow, we turn down that offer to borrow and we look perhaps to deposit instead. If we looked at these numbers and we found it was just, ridiculously cheap, it was underpriced or undervalued in whatever way, then of course, yes, we would snatch that offer off the table and say, we're going to borrow money at that rate. We'll take that mortgage because that just sounds too reasonable. Now, again, it's all through this process where we're looking at these rates, we're defining where these rates are coming from and using those to make our decisions, whether we should accept that offer or whether we should turn down the offer and take the chance. I mean, for example, we could, if we had a view that rates were going to go lower in the future, well, I guess we'd go for the first choice, where we borrow the money for 1 year, and at the end of that year, we go and re-borrow the same money for another period of time, another year at a lower rate, if that's our view that rates are going to go lower. So it's giving us choices. It's giving us a way to come up with those decisions, but now in a more informed way. So let's look at the maths behind this, and it's not that difficult. We're looking at the differences between these two valuations at the end of these two periods of time. So at the end of the first year, of course, when we borrowed that million, we're paying 6%, we owe 1,060,000. If we went for the second choice, we owe 1,166,400. The difference between those two sums is 106,400. So what is 106,400 as a percentage of the money we have at that point in time, namely at the end of the first year, well, we have 1,060,000 at the end of the first year. That's the sum we've calculated. So 106,400 as a percentage of the 1,060,000 comes in with, surprise, surprise, a rate that's approximately 10%. But we did that without any calculation. Well, no real calculation. We just looked at it as that simple average. But it's not a simple average, so it's not exactly 10%. It's different because it's a geometric average. And you can see here, it's coming at 10.04% just by using our maths. So the rates being offered today, that's 6% for 1 year, the 8% for the 2 years, is implying, due to this no arbitrage principle, that rate beginning in 1 year's time and ending in 2 years' time is 10.04%. Now, of course, we could look at that, having calculated this, and to see whether that makes sense, whether we think rates are going to be higher or lower in the future. But we've got to start with a valuation. We've got to start with that number before we can decide, based on our beliefs, based on our views, whether this is something we want to take on or not. But now, of course, we're doing it on a more informed basis. So we know that we must end, in both cases, when we apply the correct rate, here it's 10.04% per annum, we must end with the same result. If you will, we're taking two different paths to the same destination, but through this no arbitrage principle, this no arbitrage theory, we've got to arrive with the same result. And that's what these rates are implying. So what we've got today are what we call zero or spot rates. That's 6% for the 1 year period is the 1 year zero rate. The rate we have for the 2 year period, that 8% per annum, that's our 2 year zero rate. And from those, we've managed to derive our forward rate, that rate that we have called, for simplicity's sake, the 1 times 2 rate. So we're seeing, of course, where these rates are coming from. And we can therefore use these rates to see, or some rates or other rates, to see what the implication is, what the rate is being implied in other periods of time. So we're taking our zeros, in this case, and working out a forward. We can easily work back the other way, but we'll do that at a further stage. So again, for simplicity's sake, we call it a 1 times 2 forward. In the markets, if you're looking at things called FRAs, forward rate agreements, they would describe this same period of time as a 12 times 24, talking, of course, in months. Something that begins in 12 months' time and ends 12 months later, obviously in 24 months from today, and that would be what they call a 12-24 forward rate for a FRA. If we go, and we will certainly do this, into the world of swaps and swaptions, this same period would be called a 1 year forward rate. But we are, for this example, just calling it a 1 times 2 forward, just to keep it nice and simple. You could just use the rates. So we have that rate of 8% for the 2 year period. Hence, we're going to add 1 to that rate, expressed as a decimal. We're doing it for 2 periods of time, so we're squaring that, dividing that by 1 plus the rate for the 1 year period. That was the 6%. After we've done the calculation, we deduct the 1, multiply by 100, and once again, proving that we have a rate that's approximately 10%. 10% on a per annum basis. Another way to do things, and this may be more palatable for some, is to use what we call discount factors. This is often useful when you're doing things on Excel, and we will come up with an Excel sheet based on some of these numbers, which will be available to you on our website. So, discount factors. What do we do here? Well, what we're doing is we are calculating discount factors given, of course, the numbers we've just been using. So a 1 year discount factor with the rates at 6% per annum, the way we calculate it, we just take 1 and we divide it by 1 plus that rate expressed as a decimal, and we come back with a discount factor. Now, discount factors are very, very useful because we can simply apply them to future cash flows. Most investments, if you think about it, involve future cash flows. If you think about bonds, they pay us coupons in the future. If you think about shares, hopefully they pay us dividends, but again, they arrive in the future. If you buy a property to let it out, if you do a buy to let investment, then hopefully someone's going to keep paying you rent, but that rent is coming in at various stages in the future. What we need to do to really assess our investment choices is to think about all of those future cash flows on a present value basis. What is that money worth today? And we can use discount factors to do that. So if I said to you, I'll give you $1 million in a year's time, if rates are indeed 6%, then we can use this discount factor and apply it to that sum that I'm offering you in a year's time. And just using this discount factor, it's no more complicated than this, we would say that that future cash flow today is going to be worth 943,396.23. And that's how we're applying the discount factors. And this is, again, very, very useful if you're doing things on Excel. Rather than having to have lots of brackets in your formulas, you could simply multiply by a discount factor a future cash flow to work out what the present value is today. And again, we could do this for all these different periods of time. We've got that 8%. That's the rate for our 2-year period of time. And we've got that 2-year discount factor, which again, we could use for discounting 2-year cash flows. And therefore, we can use both of these to work out our forward rates. So what we're going to do is we're going to take that 2-year discount factor, divide it by the 1-year discount factor, and this is going to give us a new discount factor here, which we can simply apply through the calculation, take away the 1 at the end, multiply by 100, and guess what? We're back to our 10.04%. So all we're doing here, I know it feels like we're going back and forward, and indeed we are, but it's all about proving these numbers, proving our rates, proving whether they are correct, or is someone trying to take advantage? Do these work for us, or is this the deal we turn down? And that's why we're kind of going back and forward to prove these numbers, just to make sure we're doing the right thing. So just before we take a pause on this recording, and we're going to come back with a part 2 where we take this thought process a little bit further, let's just think about what we've done here. So we started with our zero or spot rates, whatever you'd like to call them. But we've got to realize that sometimes these are not fully observable. But they are required, as we've just seen, as we've just talked about, to discount any future cash flows. So when we're trying to establish the present value of any of those lovely future cash flows, those coupons on those bonds, or those dividends on those shares, or that rental income on that buy-to-let investment, then we need to have these zero rates. But again, they're not always fully observable. Now, we can either use the rates themselves, as we have just done, or of course use those discount factors, again, as we've just done, but we do need them in some way. But they may not be fully observable. If we do have them, if we can see them, then from those we can calculate our forward rates, as again we've just done. And those forward rates are required to derive what we call the no arbitrage market expectations. Those expectations of those future zero rates, where rates will be in the future based on what we know now. Because again, we're looking to see where these rates come from. And it's not just simply a case of going, I think this rate will be here in the future. That's where I'm going to set that. It's all based on these mathematical principles. But there's a lot of logic and there's a lot of intuition here as well, which makes it nice and easy, hopefully, to think about when we have a limited amount of time to decide. But once again, with forward rates, they may not be fully observable. So if we have our zero rates, we can work out the forward rates. If, on the other hand, we have our forward rates, we can work backwards to get our zero rates. So this is a way we can fill these gaps and we can really see where the rates come from. Okay, that's the end of part 1. In part 2, we're going to take this whole thought process further. I look forward to seeing you there.